Assalamu alaikum. In this video and the coming two videos, we'll talk about profitability ratios. I picked up three ratios. I'm going to present them now, but I will discuss each one of them in separate video to limit the video time to 5 to 7 minutes, not to get you bored. First ratio is gross margin profit. They also call it percentage of gross profit to revenue. By definition, you can guess what is this. And also we have what we call profit margin, and they may call it percentage of profit to revenue. It is simple. Third one is return on capital employed, ROCE. There are other ratios, but these would give you good idea about the ratios and the idea of the ratios and how they are used to judge the companies and their management. We'll start with gross profit margin. Stick this back. The gross profit itself equal revenue minus cost of sales. Please not to confuse us. Gross profit, revenue minus cost of sales. Then we take the gross profit itself and divide it by revenue. Divided by revenue multiplied by 100. This is the gross profit margin. As a ratio, it's not really useful, but when you compare it to the performance in the past and performance in the future, then you can tell about the progression of the management quality. Also, you can compare it to the industry, same companies in the industry, to know where you stand. Let's have some examples. Let's say revenue here was $100,000 and cost of goods sales, cost of sales is 50,000. We have 50,000 here. If you put it here, it's 50,000 over 100,000, 50%. Then in the following year, it became 150,000 and cost of sales became 75,000. So we have gross profit of 75,000. If you divide the 75,000, let's move this 100. $75,000 over 150,000. Another 50%. Although we had the revenue increased, we have the cost of sales increased in the same ratio almost, then we have higher gross profit, but we still have the same ratio, which means that the performance is stable. It's not better, but it's not bad. This depends on several things. Cost of sales, if you are able to buy the goods that you are selling in good prices, then you'll have an edge, so your gross profit will increase. Your revenue, if you are good in putting prices higher than than usual, then you can get more revenue, or you reduce the discounts, the trade discounts that you're providing. So it's up to the management, and it's up to the techniques that they are using in order for them to maximize the gross profit and accordingly increase the gross profit margin. If you're watching from YouTube channel, below there is a link to a file that describes the examples on how you can improve the gross profit margin. Thank you.